I've heard with great interest the speeches that were before me, and I have to say I could not hope for a better introduction. You have heard the problem, and you have heard an aspiring solution. And from me, what you will hear is the attempted solution that was proposed by the European Union. Now, as has been very clearly explained, and I'm not going to go into that again, the digitalization of the economy has created strains on the existing international tax rules, leading to tax competition between EU member states and prompting the EU to take action on this front. So the EU has been involved in this with the digital economy for several years. And already in 2015, the European Parliament invited the European Commission to put together a legislative proposal that would revise the definition of a permanent establishment so that digital enterprises with a significant digital presence in the EU would also be taken into account, and it would introduce a minimum economic substance test for digital enterprises. The European Parliament resolution is important because it came just 1 year after the EU Commission's high-level expert group on taxation of the digital economy, which had concluded that a new definition of taxable nexus was unnecessary, as there was no valid justification for fundamental change, radical change in specifically for digital activities.
Sorry, Venetia, sorry, Venetia, sorry to interrupt. I'm so sorry. Something I should have mentioned before you started. You'll need to let us know when you want us to move forward through the slides. We're currently on exposed to Facebook.
No. All this I've passed on based on previous. So I am now at slide 8.
Basic tax challenges, some newspapers, unilateral measures.
It's the one that says EU and European Commission.
Great. Okay, we're there. Do let us know when you want us to move on to the next slide. Sorry, back to you.
Absolutely, sure, no problem. So as I was saying, only in 2014 the European Commission noted that there was no real need to change the international rules to include digital enterprises. And just 3 years after that, the European Commission issued its communication on a fair and efficient tax system in the European Union, calling for a strong and ambitious stance of the EU in the taxation of the digital economy. And during the Estonian presidency, that was in late 2017 and mid-2018, the issue of the taxation came to the forefront, with member states such as Germany and France expressing the will for a unilateral measure that would allow them to tax income stemming from digital enterprises immediately. In total, 10 EU member states agreed to the introduction of interim tax measure during the informal ECOFIN meeting in Tallinn in September 2017, and this prompted the EU Council 3 months afterwards to adopt a conclusion on the taxation of the digital economy, recognizing the need for exploring an appropriate nexus in the form of a virtual permanent establishment. A few months afterwards, and this is the important part of my presentation, the European Commission launched its digital taxation package, which included, among other things, 2 proposed directives. One, the proposal for a directive laying down rules relating to the corporate taxation of a significant digital presence. And second, the proposal for a directive on the common system of digital service tax on revenues resulting from this provision of certain digital services. Now it's time to pass the slide, and we will start with the second directive first, which second directive aims to create an interim solution, one that would allow states to tax specific income stemming from digital economy until the reform of international tax rules that is aspired by the second directive could be implemented. The interim solution provides for the introduction of an indirect turnover tax the digital service tax that would be imposed to revenues stemming from the selling of advertising space, digital intermediary activities, and sales of user-collected data. Such revenues would be taxed provided they cumulatively meet two criteria, namely total annual worldwide revenues of 750 million euros, and second, total EU revenues of more than 50 million euros. The Commission claimed that the digital service tax is necessary to level the playing field between digital enterprises and traditional enterprises, claiming that it's time for digital enterprises to pay their fair share, making arguments in relation to what is just, similarly to what has been previously mentioned by the previous speaker. However, this proposal has been criticized and has been met with skepticism by various scholars and nations alike, inter alia because of the fact that it applies only on specific types of income. As stated, the digital service tax aims only revenues derived from three types of activity, namely from digital online advertising, from digital intermediary activities, and from sales of user-collected data. What's more, in December 2018, in an effort to get member states' consent on the proposal, France and Germany agreed to limit the scope of the digital service tax to revenues only from online advertising. This demonstrates in a very clear manner that there are no objective criteria behind the reason why only specific types of activities are being taxed. Instead, there seems to be that there are random policy choices made by the Commission. This is not only problematic on the basis of EU law, but it can also be problematic from a WTO perspective, as the digital service tax de facto would target and affect specific multinational enterprises residing in the US. This could lead to a prohibited discriminatory tariff under the rules of the World Trade Organization, which would put additional strains on the relations between EU and the US. The second proposed directive, and it's now time to move the slide, the second proposed directive lays down rules relating to corporate taxation of significant digital presence. The proposed directive departs from the traditional permanent establishment definition that links the right to tax with physical existence of a business, and instead extends the notion of a permanent establishment to where significant digital presence exists. As to what constitutes significant digital presence, the directive follows three criteria, namely, if a non-resident company offering digital services through a digital interface satisfies at least one of the following criteria: 7 million in annual revenues, more than 100 users, or more than 3,000 contracts for digital services with business in the EU. The proposed directive aims to extend but not cancel the existing definition of the permanent establishment so as to align the creation of value with taxing rights in the digital economy, something that is also pursued by the BEPS project. Indeed, taxation of profits in line with value creation appears to be the new golden standard in the national tax law, which begs the question, where is the value created in a digital enterprise? This was easy to establish in the traditional enterprises because the value was created where such enterprise had its factors of production. But as has been already discussed by previous speakers, it's much more difficult to do in digital enterprises. The proposed directive takes into account three criteria: sales, digital transaction, and the numbers of users. And although these criteria have been criticized by several scholars as being only indicative and not determinative for the place of value creation, It is my view that the criteria are in the right direction and are based on sound tax policy. The criteria need to be further specified and diversified, taking into account the particularities of the various models of operation of digital enterprise, and be imposed only in case where there is true value created. But nonetheless, as mentioned, they are in the right direction.
Venetia,
Currently,
can I just give you a 1 minute warning?
Yes, currently,
Fantastic.
such proposals have brought much controversy between member states and scholars alike because of their implications for the existing tax treaty network, their design, their purpose, their aims they wish to achieve, and for not waiting an international solution. Not surprisingly, the diverging interests of EU member states have barred the adoption of such proposals, as for such adoption, a unanimous approach is required. To this end, the EU is now waiting for OECD's attempts that are expected to be concluded in 2020. But what does that mean? Are the proposed directives futile? In my opinion, no. I find that if the EU member states have failed to concur on a solution to tax digital economy, the possibility of 127 states agreeing on a solution appears distant, to say the least. To this end, with an international solution appearing difficult at this stage, it is very likely that the discussion for the two proposals will spike again after 2021. Thank you very much.